Back in September 2008, a financial institution that had been around for 158 years, it just vanished. The cost? We're talking millions of jobs, homes, trillions of dollars in wealth, all gone. But here's the thing. This wasn't some random accident. It was a tower built very carefully, block by block, on a foundation of pure lies. Let's pull back the curtain and see how they built it.
Look at this number, -$600 billion. That's the hole Lehman Brothers punched in the global economy when it went under. I mean, it's a number so huge it's almost meaningless, right? Try to wrap your head around that.
So, that's the billion-dollar question, or I guess the $600 billion question. How does a pillar of Wall Street, a company that survived world wars, the Great Depression, just evaporate? Well, the answer is somehow both incredibly complicated and shockingly simple.
And believe it or not, this entire global meltdown, all the chaos, all the pain, you can trace it all back to one single, very seductive idea. An idea that everyone, and I mean everyone, bought into. So let's start right there, at the beginning.
Okay, to really understand why the tower fell, you first have to see the cracked foundation it was built on. And for that, we need to rewind a clock to the early 2000s. It was a weird time of national anxiety, unbelievably cheap money, and, well, a new national obsession.
This was the mantra. It was everywhere. On billboards, TV ads, coming from every mortgage broker you met. And it wasn't just a sales pitch, It was sold as a core piece of the American dream. And pretty much the entire country took the bait. Hook, line, and sinker.
So why was this message so powerful right then? Well, you had this perfect storm brewing. After 9/11, the country was just on edge. To get the economy moving again, the Federal Reserve slashed interest rates down to almost nothing. All of a sudden, money was dirt cheap. Borrowing was a breeze. And America's national pastime went from baseball to flipping houses.
And here it is. This is the first really wobbly block in our Jenga tower. To keep that home buying frenzy going, banks started pushing something called subprime mortgages. These were loans specifically for the riskiest borrowers, people who, in any normal world, would never get approved for a mortgage.
And just when you think it couldn't get crazier, it got truly absurd. Meet the ninja loan. Seriously, that's what they called it. Lenders were literally handing out hundreds of thousands of dollars to people with no income, no job, and no assets. All the old rules, gone. Basically, if you had a pulse, you could get a mortgage.
Okay, so the country is basically drowning in all of these incredibly risky, frankly terrible loans. But this is where Wall Street steps onto the stage. They've got what they think is a magic trick, a way to turn all this financial trash into treasure.
The recipe was actually pretty simple. Step 1, take thousands of those awful ninja and subprime loans and bundle them all together. Step 2, slap a fancy new name on it, a mortgage-backed security. Step 3, and this is the key, pay a ratings agency to give your bundle a safe, top-of-the-line AAA rating. And finally, step 4, sell this ticking time bomb to pension funds, to cities, to investors all over the globe, telling them it's as safe as gold.
So, you're probably wondering, how in the world did all this junk get a safe rating? It's simple, really. The very agencies that were supposed to be the impartial referees were getting paid fat checks by the banks creating the products. It's like letting a student grade his own final exam. The conflict of interest was just off the charts. So, to the public, to your retirement fund manager, these things were sold as safe, investment-grade assets. But the guys on the inside, the ones who cooked them up, they knew exactly what they were. They had a nickname for them, financial plutonium, incredibly dangerous and highly toxic. But here's the thing. Not everyone was fooled. There was this small group of outsiders, weirdos, and contrarians who looked at this teetering Jenga tower and saw it for exactly what it was, a structure that was absolutely doomed to fall. And they decided to do something nobody had really done before. They decided to bet against it. And the weapon they used to make that bet was this thing called a credit default swap, or CDS. Now just think of it like an insurance policy. It pays out if something fails. But here's the absolutely wild part. You didn't have to own the thing you were insuring. It created this massive, unregulated global casino where you could bet on literally anything to fail. It's a dark analogy, but it's perfect. Imagine buying a life insurance policy on someone else's grandmother, a person you've never even met. All of a sudden, you have a direct financial incentive for something awful to happen to her. That's exactly what Wall Street was doing, but they were doing it with the entire American housing market.
For years, this insane party just kept raging on. The tower got taller, more and more unstable. But in 2007, the ground started to shake. And in 2008, well, the whole thing came crashing down.
And man, the dominoes fell fast. It all started when home prices, which everyone assumed would go up forever, actually started to fall. Suddenly, all those so-called AAA assets were exposed as worthless junk. Panic hit. On September 15th, Lehman Brothers declared bankruptcy. And almost overnight, the entire system of global lending just froze solid. It was like someone pulled the plug on the world's economy.
And the human cost was just immediate and devastating. 8 million. That's how many jobs just vanished in the United States alone.
4 million. That's the number of families who lost their homes to foreclosure. Think about that. 4 million foreclosure notices.
You can see the shock to the system right here. The unemployment rate in the U.S. more than doubled in just 2 years, soaring to 10%. This wasn't a Wall Street problem anymore. This was a Main Street catastrophe, plain and simple.
So standing there in the rubble of the collapse, the government had to make a choice: let the whole system burn to the ground, or step in and bail out the very institutions that started the fire. And what they decided to do created this story of two very, very different Americas.
I mean, the contrast couldn't be more stark. Wall Street got a $700 billion bailout from taxpayers. Main Street got eviction notices. The bankers who caused the crisis, they got record bonuses. Not a single one went to jail. Meanwhile, regular families lost an estimated $19 trillion in wealth and ended up in lines for soup kitchens.
This feeling of a rigged game, of deep injustice, it didn't just go away. It boiled over into pure anger, and that anger found its voice in the Occupy Wall Street movement. This phrase, "we are the 99%, it became the rallying cry for a whole generation that felt the system had saved the rich and powerful and left everyone else behind.
In the end, the government's plan worked, in a way. The global financial system didn't totally implode, but it leaves us all with this final, really uncomfortable question. The Jenga tower was put back together, the system was saved. But when you look at who paid the price and who got rewarded, you just have to ask, who was it really saved for?